Breaking news here on the Day Trader. Well, it's official. What I've been telling everybody for a while now is official. Hello, bear market. We are in a bear market. We have officially hit a bear market in the S&P 500 as of today's close. It's been a tough day, as we all know. The S&P 500 total return is now down at 21.3%. Tell me about it. You can see my portfolio here from its highs at the start of this year, breaching down the minus 20% mark. It's been a very tough time. How did we get here? Well, that's a good question. Two words, in my opinion: stimulus and expectations. Everybody spent their stimulus checks now. Soon after COVID hit and the world stopped, the Fed jumped in to stabilize the foundation of our financial system, the bond market, with $4.5 trillion of security purchases. It was followed by an additional $3.6 trillion of US government money. You all remember that, right? First to businesses and then to the consumer directly through extra unemployment benefits, child tax credit payments, and checks in the mail. You remember all of that stuff? Well, it's now come to an end. Today we find ourselves in a place where all that helpful stimulus money is unwinding. Since the start of the year, the market has been trying to find the correct expectations of the future. So let's break all this down a little bit. The inflation report was a little higher than officially expected by 0.3%. We thought we'd peaked earlier on, but no, nevertheless, it gone up again. And with the benefit of near-term hindsight, it seems that unspoken expectations were for inflation to come even lower. So anything at the same level or even mildly higher was going to set off the stock market drop we got on Friday, following through to today. The greater reference valuation, the value the market agrees to pay today for companies' future earnings, is that it's trying to find what businesses should be worth in the future. Knowing the stimulus is gone and inflation is here. We certainly know that, right? In terms of numbers, the 12-month forward priced to earnings ratio, the PE ratio for the S&P 500 index, is now about 16.5x, down from a peak of 23 last year. In historical context, this is in line to above some of the historical averages: 10-year 16.9, 20-year 15.5, and 25-year 16.5. So the question is, will the markets continue to fall? Will this carry on? Well, anything is possible. Looking back to 1945, where bear markets occurred 70% of the time they related to a recession, and the average return during a recession was down 30%. From here, further drops in the market depend more greatly on the E, as expectations for the next 12 months and for 2023 are high and likely need to come down. For context, aggregate earnings for the S&P 500 index are expected to be 10% higher for each of the next 2 years. That seems inconsistent, though, with rising costs and the related expectation of slowing growth. So as a result, it's reasonable that earnings may actually be lower than current expectations by 5%. Assuming that is about right, in my analysis and what the information that I'm looking at right now, it could mean market levels would look closer to a fair value if down further by mid-single digits. Thus, the S&P 500 would come close to 30% down for the year and in line with the average for a recession. Don't you just love all this information? Will we have a recession? Well, I think we're already there. It's very possible, but I think we're already there. Led by a reassessment of corporate earnings while they cut their costs from higher expenses and softer demand. If that's right, we're about 2/3 of the way through the market downturn, closer to the bottom than the top. Well, that's kind of obvious, really. I mean, but could we get much lower? Of course we can. But I feel that we are nearer the bottom, much nearer the bottom than the top. No question about that. Could we be wrong about all this? Is it possible that I've got all this wrong? Well, yes, and we sort of hope we are. If I'm honest, I do hope that I am wrong. But anyway, we'll see. Evidence of better earnings growing, a quicker cooling of inflation than expected, and even ancillary events such as a true shift in COVID policy from China, ceasefire in the Ukraine, in Russia, that would all help, can quickly shift expectations positively. So if we get any good news about the war or inflation or anything else or COVID, things can dramatically swing. So always be positive, right? So what does this mean for us investors? You know, we're all investing in the stocks at the end of the day to grow our wealth, to give ourselves financial freedom. Diversification is why my biggest part is VU. It's often the answer to a lot of investing questions. It's never a bad time to review your positions. I'm always checking my positions, always reviewing it every day. Even make a new one if you feel it's right to do so. When looking through your portfolio, consider the balance of holdings. Higher quality or lower valued areas such as dividend stocks and those in energy and healthcare can be attractive to investors. I mean, that's why I am primarily in VU. The biggest part of my portfolio is VU, but I'm also in high-tech stocks as well, which will change the future and benefit the world. Volatility is higher these days, but try not to let it trigger an investment reaction. If you feel that the markets are moving, try to be calm. It's what we do on our show every day. We calm and we think about what we're doing. Take our time. Very, very important. Don't rush into anything. Stay in the course, made with the right decision, as equity markets have historically provided positive returns over the long term. Just stay calm, relax, buy into good stocks. Things will come right in the end. You shouldn't be selling out right now unless you need the money, unless you've invested in the first place with money you couldn't afford to invest with. That's often the case. Join us live on the Day Trader every day as we break all this down. And whatever you do, take care of yourselves and each other.